Hello everyone, welcome to Yorkville's 5 Under 5 series, 5 slides on markets and economy in under 5 minutes. We hope you find this information useful, and if you have any questions regarding the content of this presentation, please do not hesitate to inquire with your relationship manager or by sending us an email. Please be aware that this presentation does not constitute any form of investment advice and is only reflective of information that is available to the presenter at the time the presentation is being made. The material presented is just for information use only. Please speak to your advisor prior to making any investment decisions.
Good evening, everyone. I have a little more than 5 slides, so if you can forgive me about that. But my name is Ralph DeSando. I am the Managing Director of Private Investments at Yorkville and lead the healthcare fund and the private equity initiatives of the firm. I'm really looking forward to providing this update to all of you this evening. The Yorkville Healthcare Fund was launched in 2012. We launched it with the intent to give investors access to the healthcare market or healthcare investment space in Canada that they otherwise couldn't get to. And we've been very successful in doing that. It is a yield-based fund that provides a steady stream of distribution as its goal, as well as capital appreciation for its investor. We have grown since 2012 to about 235 million. As of today, with the investments for December 1st, we're probably around 240 million of investor equity and about probably 450 million of assets in the underlying funds. We've successfully built the 5th largest elderly care provider in Canada with resident capacity of 3,400, including those beds that are under construction today. We've also built and been involved in building the largest institutional pharmacy across Canada, serving over 95,000 residents. So we truly believe, and I hope you would agree, that we are making a difference in Canadian healthcare. And I can't thank all of you enough for being part of this journey with us. So for those of you, again, this may be a repeat, but I do like to highlight the structure of the fund and why it is tax efficient. So the triangle represents the investors and the location of where they are. It's considered a non-81 102 mutual fund. It holds, and the 3 ovals are limited partnerships. The reason for the use of limited partnerships are they are flow-throughs. So when you put an investment vehicle such as a trust that holds limited partnerships, they're perfect flow-throughs for tax. So as there is no taxable income in this structure, the cash that is generated through the secured debt and through the Southbridge LP through the elderly care portfolio are considered return of capital, thereby deferring the tax that results until such time as the investor redeems them. So I did want to highlight that. From a valuation perspective, it's very simple. Every quarter, those 3 items are valued, which generates the NAV. In 2020, we had a significant number of milestones, and 2021 is really no different. We are on track to meet our targeted returns of between 8 and 10% a year, which is exciting as we've exceeded those in the past year or so, or year or two. Equity, couldn't be more pleased. Year to date, we're at 48 million versus 37 million in the same period, but we're on track for 52 million to 55 million versus 40 million in 2020. That's quite a large growth, which is really a testament to our success. We've been able to add new distribution channels with large banks, which is exciting, and really expanded just recently our sales teams to the Western provinces. We're looking to also expand out east. But again, the success and what we've been able to provide investors is really a function of why we are succeeding in gaining new equity and growing. April 2021, something that Yorkville worked with Southbridge and its founder for over 2 years, almost 2 years, which is an agreement to internalize management and the GP to the fund. We received an acknowledgement letter from the Ministry of Health in October, and we project to close that in Q4 or Q1 2022. The importance of this, and I can't really underscore the importance of this, is that We committed for many years now to reduce structural costs, and we have done that successfully. This continues to reduce structural costs without reducing costs in the operations or the care envelopes. It also enhances governance and is accretive to the fund. So again, very exciting that we were able to culminate this. We look forward to closing it and continuing to work with management and the board of Southbridge to continue providing great elderly care, improving care, and returns to our investors. We expanded the investment silos to include secured debt. That allowed us to mitigate risk and also increase tax efficiency in the fund, utilizing tax losses that existed at the fund level. But overall, I have said the message, and I continue to say this message, is that elderly care cannot be fixed by the government alone. We are leading the change to become the part of the solution, and I applaud everyone that is part of this, that they are being part of the solution. We continue to focus on improving elderly care, and we're committing the equity needed to move projects forward, both current and planned. And I'll talk a little bit about the status of these projects and what they look like. And it's pretty exciting to see what we've been able to accomplish in less than 2 years. Our fund performance, again, something that I'm extremely proud of, and really the performance is a function of its diversification. As Southbridge and its LP has been utilizing a significant amount of cash to build out its development and construction programs, our vertical integration program with internalizing institutional pharmacy has been a large success in our opinion, and I hope you would agree. It's resulted in the fund achieving higher overall returns. The secured debt, the convertible debt related to our institutional pharmacy has allowed us to continue the yield, the stability of the NAV, and also mitigate our risk over multiple healthcare silos. So I trust that you could see that since inception, we've delivered over 9.2% return in Class A, and this is net of fees. Again, outperforming the cap rate index without the volatility that you see in that. So what have we done in 2021? Again, I do mention that it was a busy year. Yorkville participated heavily in the growth of CareRx, in the acquisition of SmartMeds. We participated with 5.1 million of equity, but more importantly, with the industry changing acquisition of the medical pharmacy division, we participated with 11.5 million in equity at 505 a share, but we also participated with $6 million of additional secured debt, consolidating our debt position to 20 million in total for 5 years at 10.5% interest. Again, as I mentioned, it is a balancing act between capital appreciation through either the long-term care sector and debt, and also the upside potential of the equity positions. And we've been able to, in our opinion, successfully balance that such that we've been able to continue the yield for this period and the foreseeable future. With respect to Southbridge, we continued to provide debt to finance the redevelopment programs of about 10.7 million between January and March. And then upon the successful negotiation of a reduction in fees to the Southbridge GP, we commenced adding equity, which totaled $16 million between April and October. The importance of this equity is that there are new units with 0% fees to Southbridge. Again, a fulfillment of our commitment to reduce structural costs to the business. This allows more money to stay in the business for redevelopments and growth of the business for future value to our investors. Something that was extremely exciting was the successful renewal and increase of our Scotia line of credit from 20 million to 30 million. This will allow us to ensure we have the capital needed for the funding of redevelopment, as well as the equity needed to fund internalization. More importantly, the due diligence done on Scotia over the lawsuits, and there really is nothing new to report other than they continue, and there is no settlement that our insurance company wishes at this time. They were satisfied in terms of the risk to the fund and investors, so they were increased the line. that really is a testament to the strength of the business. And also Bill 218, which was a bill that indemnified care operators during the pandemic. As of October 31st, the fund basically had a net loan position of about $10 million, 13.5 million on the line and 3.1 million in cash. That's down from about 20 million. And I project that to be somewhere around 5 to 6 million by the end of the year based on the current equity that stands for December 1st. So again, very successful use of that line of credit. As you know, we do not have large institutions that fund $20 million increments. This allows us to continue our accredited investor and distribution channel approach to equity. I just want to highlight the size of our portfolio. As you can see, the 3,100 beds for Southbridge is the 5th largest. It does not include the 280 bed currently under construction or the additional 355 licenses that were granted. I will provide some more color on these licenses that were granted, the locations that they are, and the homes that they will impact to show you the continued growth of the portfolio. In terms of financials for Q3, you can see that AFFO for Q3 was 2.4 million, and of which distributions on development assets were about $1 million. Although total distributions were in excess of AFFO for the quarter, we do believe that this is temporary as we are funding distributions on assets that are not currently generating cash flow. So we're effectively, with the other distributions, able to reinvest some of our distributions to even it out. As I mentioned, the 4 development projects coming on stream June 2022 are projected to generate accretive AFFO and NAV, bringing the total distributions back in line to where we like them to be. So again, it is temporary. We knew that, but having the distributions or the yield generated from the secured debt allowed us to continue the yield, and we're at the goal line of our new homes coming on stream. Again, I can't stress enough, the diversification has really positioned the fund to manage development successfully. It really has, and I'm quite pleased with that. Q3 AFFO was lower due to insurance costs as well as management fees related to pandemic funding. As you know, our management fees are based on total funding. Internalizing those management fees will also allow us to lower those management fees for future funding. Also lower occupancy from retirement homes, but although it was a low of 79%, again, we can really see the recovery of retirement homes as our occupancy grew to 81% in Q3. In discussions with management, they continue to believe the retirement occupancy will continue to improve in Q4 and beyond, attempting obviously to get to that 83, 84%. As you can see, the business continues to run in line with our expectations with a payout ratio of 83% on operating assets. As I mentioned, the redundant assets will come on stream Q2 of 2022, opening 4 facilities, and will be the first long-term care provider in Ontario history to open 4 long-term care facilities virtually in the same month or 2. So that's, again, pretty exciting and a testament to management's commitment in the board and what they've done to improve elderly care. I do urge anyone that has had an opportunity or can have an opportunity to come and visit these sites. We'd be pleased to do that. It's pretty cool to see. More importantly, as seen here, we continue to grow the portfolio, and the Ministry of Health's continued commitment to work for profit, not-for-profit, and municipal operators. Our new license grants totaling 355 net new beds in Port Hope, Goderich, Thunder Bay, Chelsea Park, and Port Perry. You can see these homes will be inconsistent in size, but multiples of 32. Last but not least, there are no COVID outbreaks in our homes as we continue to manage. All of our residents receive their booster shots. And so we continue to manage that successfully through the pandemic as operations return more and more to normality. These are some updated photos of what we're seeing today in the homes, and you can see the size and scale of these homes. They're very similar in design. They have each of the floors in sections. The wings of these homes are resident home areas of 32 residents. The areas that you could see are where there are look like balconies are the common areas for the residents and the kitchens. Each of these homes are about 155 to 160,000 square feet, so they are extremely large. And some of these aerial photos really give you a sense. For those of you that live in or near Ottawa, the Kemptville area, I was just in Kemptville last week, and they actually have the parking lot paved in Kemptville. So pretty cool. Each of the project managers is quite proud of what they're doing, and it seemed to be a little bit competitive in terms of who's getting theirs done first. Cornwall is started a month later, so you can see that the roof isn't quite finished, but they do believe they'll have the enclosure completed by the end of December. And London is actually pretty cool. It's a K design, and the reason for that is that there is a lot of there's less space there. So we'll talk a little bit about the private equity LP, which holds our current integrated or vertical integration thesis of CareRx. The private equity LP performance since October of 2019 has delivered 34% annual return. So it has done exactly what we needed it to do, what we believed would be the value that was created by vertically integrating and consolidating or rolling up all of these institutional pharmacies. The roll-up started with Centric Health at 31,500 beds. We then purchased Remedies RX. After that, we bought SmartMeds. We bought part of Rexall's long-term care business. And last but not least, we bought the medical pharmacies business, long-term care business, creating a 96,000 bed service provider of homes across Canada. It's exciting that we've built something that is across Canada, the largest, and in a short period of time. We are extremely pleased at Yorkville in terms of the success of this, the earnings, the EBITDA, the revenue, the consolidation and synergies of costs that haven't yet even commenced with medical pharmacies. So again, very pleased by this. In terms of those of you who haven't followed CareRx, Q3 exceeded expectations of analysts, with revenue growing 56%, adjusted EBITDA 79%. Average beds, I believe, were in the 80-some thousand range. One of the things is the contribution from medical pharmacies was only part of the quarter, and it didn't include any short-term and non-recurring cost savings. So again, very exciting to see where this business is going, and all of this is on their website. It's we're an insider, so therefore we're merely providing information that is currently in the marketplace today. You can see by this slide really the size of the growth, and what is really exciting is the adjusted EBITDA of $15.3 million year to date, from basically $3.1 million in 2018, just previously before we got involved as the majority shareholder. So again, very excited to see the trajectory of this business. It's doing exactly what we had hoped for. Very pleased with management and the strength of this management team. Some of the other highlights, again, as noted, is they did expand their an existing contract at 1,500 new beds. They onboarded those in Q4, so it's not in Q3 numbers. But importantly, all of these beds are serviced through the existing infrastructure. One of the things, or two of the things that Yorkville was a big proponent of when we looked at this was actually the technology aspect of the institutional pharmacy space and utilization of the infrastructure that's in place. CareRx has expanded its partnership with Think Research. Think Research is an online virtual healthcare provider to Chartwell residents. Following a successful pilot project, they're now expanding that and offering it in Ontario, BC, and Alberta. What that does is where residents who are not currently receiving medication management are having virtual healthcare meetings with their provider, they are able to get their medications from CareRx. So again, it's expansion of not just an institutional pharmacy, but a technology aspect, which is really where we need to, in our opinion, continue to grow towards. Carey, again, another technology aspect of the business, which was a pilot project with Seasons Retirement. Carey is almost like a handheld phone that manages elderly care medication, reminds them when they should be taking it, tracks it, gives them alerts. This study showed that compliance increased to 97%. So for those of you that have parents living alone, living in retirement homes, medication management is always important. Make sure they take their meds. This Carey program was so successful that they're rolling it across Seasons retirement communities across Ontario and Alberta. So again, it's an expansion of the existing model using existing infrastructure. So it is exciting to see how you could take a business that is mature and really layer on these new technologies to it. So congratulations to the team at CareRx on this. From our perspective, you can see, when we started to invest in September of 2019 to today at the share price of $5.28, peaks and valleys in the stock, but we look at the overall long-term growth of this. You can see the valleys are where there's no institutional buying or there's very low volume. As larger volume is occurring, you'll see the spikes. So although we can't comment on the share price, it does illustrate the long-term value that we see has been going, and we're quite pleased. Again, it's to date about 25 million of unrealized gains for the PE fund, so generated accretive yield. So again, a balance of both yield and upside for our investors. So where do we go from here? Today, I can sit here and actually concisely outline the next steps for the healthcare fund, where we believe we can continue to create and unlock value for our investors. First and foremost, completing internalization to this further reducing structural costs and enhancing governance. Secondly, completing and opening the 4 new facilities in Q2 2022 and commencing renovations in London, Kemptville, and other homes, as well as starting construction on our new developments in Goderich, Port Perry. We continue to work with management to determine the highest and best use of redundant properties in the portfolio. As you can imagine, as we're building out these new homes, we have been sitting on land for a significant period of time that has potentially significant accrued gains. Currently, we're working with management to determine what is the best use. Should they be sold? Should they be redeveloped into different types of facilities? And so that's pretty exciting. Currently, Owen Sound has 2. There's Cornwall. Kemptville is going to turn into a retirement home. So as you can imagine, all of this, in our opinion, will unlock value in the next few years for our investors. With all of that, we'll continue to raise equity to meet the needs for these developments. And also, as the government adds new beds or does proposals for new beds, we'll certainly look to add to our portfolio. From our private equity LP, looking at further consolidating industry players, coupled with continued organic growth. We are seeking additional opportunities, and I'm looking to do hopefully a food services pilot in Q1 or Q2 2022, as you know, to enhance resident safety, as well as perhaps monetizing the value of those potential contracts. So again, I do appreciate your time. I hope this really gives you a sense of what we've done, where we're going, the path that we're taking, and the value that we are are planning or project to create for our investors. Should you have any questions, please don't hesitate to email me. And thanks again for your time and your continued support.
The information in this podcast does not constitute research or recommendation from any Yorkville employee or entities to the listener. Neither Yorkville nor any of its employees makes any representation or warranties as to the accuracy or completeness of the statements and any information presented in this podcast and any related or associate liability therefore. The views presented in this podcast are not for any investor. Listening to this advice should not be considered as receiving advice from Yorkville or constituting a client relationship of any sort, even if such a relationship already exists. Speak to your advisor prior to investing. Investing involves lots.
Have a good night, everyone. Thanks so much for your time. Rial, thank you so much for all your time. Perry, appreciate it. Keith, thanks. David, Ashes, great. It's awesome seeing you guys. Thank you.